Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
I was meeting with some clients and delivering their tax return after we had prepared it. And when I went before them, I said, "Hey, you guys, this is great. You're in great shape. You paid no taxes last year to the federal government. All the money that you paid in, you're getting back, and that's a great place to be." Well, I was thinking about it, looking at your situation, and have some strategies for how we can, over the next few years, will pay taxes. And but we're going to get you to the point to where by the time you're around required minimum distribution age of 72 years old, you'll stop paying taxes and you won't pay any more taxes until you're under current tax rates, and as long as you both live. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about 2022 tax facts. And Dad, you like paying taxes, huh? You want to get people paying more taxes?
Well, taxes are on sale right now. And so I don't mind having people pay some taxes now, because it's going to be, if they pay them now and go into a tax-free methodology, they won't pay any later. So it will be, it's cheaper. Everybody likes a 50% off sale, right? So for some people, taxes are on sale 50%. For some people, they're on sale 3% or so. But nevertheless, I like them being able to get a discount on taxes if we can. And as you well know, in 2025, tax rates are currently scheduled to go up. And then the big thing is when one person dies in a couple, when people are married, they go from a married filing jointly basis to a single basis. And with that, their tax rates go up. And when you have the RMDs coming in, that can create quite a tax situation. That's why the IRS has given people until 72 so that they make more money.
So what are some of these tax facts? What are some of these things people should be watching out so they can start planning for 2022? We're not talking about 2021, although maybe there's a couple things people could do, but most of that's already over. Right. But it's time to start looking towards getting ready for 2022 taxes.
You're exactly right, Dan. So many times people at this time of year, they're preparing their taxes. Their tax preparers are just concentrating on getting the numbers done. They're not doing any tax planning. The only basic thing you can do for 2021 at this point is damage control, maybe. But 2020, this is a great time to be thinking about what to do in 2022. And especially with some of the things we're going to be talking about on today's show, it's very relevant. As the earlier you get started in 2022 for those, the better off. But this thing that I'm talking about with these clients that I started the show with is the idea of Roth conversions. These particular clients had Social Security and some pensions. They had enough money to live on, so they were they're fine as they are. And recognize that, they have IRAs, and at 72 years old, at the time we did this, which was a few years ago, we've been on this methodology for a few years now. They're about 67 years old or so, and got on this methodology of converting their IRAs to Roth IRAs. And they had a bracket to fit in, and so we were bumping up against that bracket, so that we would do this in a methodical way of converting their IRAs to Roth IRAs. Now, we had to pay the taxes on those on that conversion, which is fine. They're okay with that. But once we pay the taxes, we're done. No more taxes. A lot of people don't understand that, right, Daniel? With Roth IRAs, people think, well, I'm going to pay tax on it. No, the whole idea of Roth IRA is you put the money in, you never pay tax again on that within the parameters as set forth for Roth IRAs. And so in this example, they're paying the tax, they're converting it to Roth IRA, and in the future, when they're in their 70s, they won't have to take out the required minimum distribution, because unless it's a Roth 401k, you don't have minimum distributions on Roth IRAs. So they can still have the money available to them, but they don't have to take it out if they don't want to take it out. So that's a great place to be.
Yeah, it's pretty cool that that's still available to people. Who knows how much longer it will be available as far as Roth conversions, because the government is really looking for everywhere where they can find tax revenue, right? So they have artificial intelligence. They're building up the IRS, and they are putting together task forces to find money that was not either tax returns that were not either done properly, or other ways they can find money, whether that be through changing laws to take more money from crypto, or if that's to get money back from all the PPP stuff that they sent out for people who didn't do that right. So they are doing a lot of things, especially with software, to be able to find tax cheats and things like that. So those may be good, but they are looking for all kinds of ways to find this money. And so to get ahead of that, right, we always talk about playing a few moves ahead, right? We've been talking about diversification. We've been talking about preparing for the unexpected. And now look at all the unexpected. All right. You've talked to how many people that say, oh, well, I think things, what NASDAQ's down 18%, S&P's down 12% year to date. And it's like, well, were you prepared for this? Did you have a portfolio that was built to handle this? So we're always talking about planning ahead. And that's why we're talking about these Roth conversions now, to plan ahead for what we see is going to happen. We planned ahead for all this craziness, and our portfolios are down, 2.5%? For the people who are in the moderate stuff, not the people who are in the safe stuff. The people in the safe stuff haven't lost anything. Right. But that's an example of looking ahead to see what's going to be going on. And we want our listeners to be able to prepare themselves as well as possible.
Exactly. And, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 2022 tax facts. And we have a paper that we have put together for you if you'd like to be able to understand these things a little bit better. And it's called Financial Advice During a Crisis. Financial Advice During a Crisis is free for you for the asking. Just call us at 800-725-7616. Daniel, when we're talking about this, I love what you're talking about from the angle of, preparing ahead, being prepared. You can't predict, but you can prepare, whether that's with your portfolio or with that's, your tax strategies that you're using. We always talk about diversification in the portfolio, and there's also diversification when it comes to taxes. And there's, most people have most of their money in pre-tax accounts because they have 401ks and they built up their savings from 401ks. And that's all, generally speaking, all pre-tax, so that when they take it out, it's going to be taxable. And that's problematic if all your money's taxable. Then if you want extra money, $50,000, $100,000 to go on a special 50th anniversary trip or whatever the case may be, take the grandkids and kids somewhere. Well, now you're going into a new tax bracket where if you had tax-free money to take that out and diversified from a tax standpoint, then that's a great place to be. And of course, there's tax-free, there's tax-deferred, there's tax preferred, there's tax advantage, all kinds of different angles of being able to have tax strategies. But this one that we like a lot is the Roth IRA. And, when you're talking about the IRS going through and seeing, how they can raise money, think about it, right? My aunt, a very smart business lady that has passed away, gone on to be with the Lord, as used to say, we need to have a class in school about the government, and the first class needs to be the government has no money. Which government has no money? They get money from us. And how do they get money from us? Well, they use the IRS. The IRS is the portion of the government that brings in the income to the government from our pockets. And So this just makes sense that they're looking for how to do this. It's really interesting, when it came out in 1974, 1975 with the IRAs and the whole pre-tax idea, and they said, okay, at 70 and a half, you have to start taking your money out, which has since been changed to 72 years old. But, this was a kind of like an annuity, kind of like a pension for the IRS that they saw coming, because back then maybe you would have paid $500, if that much, or a few $100s on your $2,000 you put in your IRA in 1974, 75. But today that's probably worth $10,000 of growth or more that they're getting a chunk of, and we'll be getting a chunk of. So they're going to make more money, and with this minimum distribution becomes a pension for them. So it's real interesting how they've designed all this.
Right. And so you're talking about those contributions back when IRAs started for like $2,000 or something like that, and they've continued to go up, right? And so 2022, one of these facts in 2022, not the contribution for an IRA or Roth IRA, but for a employer sponsored plan, they've gone up again. And so there's a couple of ways to get money into a Roth, right? One of them is you can contribute in a personal account if you qualify. And the limits are pretty low as far as income earning to get money in a Roth IRA. But if you have the ability to do it through your employer sponsored plan, you can do $20,500 per year. So that's a good amount of money you could put into that. And then if you're older than 50, there's a catch-up contribution. So you can do another $6,500. And there's not an income limit on the employer sponsored plans.
Right. So, if you're over 50 years old, you can pump $27,000 a year total into your 401k. If you can afford that, you can do as much of that. And so that's a great place to be. And depending upon your income bracket, you could potentially still do a $7,000 Roth IRA contribution for yourself. Or for your spouse as well as yourself, depending upon your income limits and that kind of thing. So you could pump away, $14,000 tax free, and then $27,000 depending. A lot of companies now are having Roth 401k, so you could put $27,000 in your Roth 401k and do another $14,000 into your Roth IRAs. And if your spouse can do the same thing, you could put away a lot of money, right? I mean, that's like close to $75,000 that you could put away in Roth if you had the money and were able to do that from that standpoint. Well,
and remember, you touched on this, but I want to make sure that this is clear. And you never pay tax on that money again.
Never.
So if you say you put that money in, the money comes out tax free, but then if you use the rule of 72, right? 72 says your money will double in 10 years if you can earn 7.2% compounded. That means you've doubled your money now. So all of it can come out tax-free. Or if you're taking income from it, your principal stays intact and you collect the income tax-free.
When is $1,000 a month that you're receiving not $1,000 a month? When you have to pay tax on it. If it's tax-free, it's for me. And today's topic on financial strategies with Andrew and Daniel Agemy is 2022 tax facts. We're glad that you're with us today. We're going to have to take a break, and we're giving away a book. It's more of a booklet than a book, but it's called Tax Invisible. Tax Invisible, and it says how to legally emancipate your money from income taxes forever. So here's an idea for people. Some people like it, some people don't, but we've got this book for you for free for just the asking by calling 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
That, growing up, my brothers and I were always thinking of ways that we could make money. And so we'd go around all the neighbors and we'd ask if we could clean up their leaves and mow their lawns. And I think all of our neighbors have moved, so I could say this now, but they were kind of jerks. They wouldn't hire us. Like, it's $20. We probably would have been happy with $5 to mow the lawn. And they wouldn't do it. And we were hard workers. They would have got their money out of it of multiples.
That's
and
right.
Nobody really did it. So that entrepreneur spirit, they if a kid came and asked me to mow my lawn, like, at least if you're worried about liability, pay him to do it and let him go, right? For at least coming by and doing it if you don't want them to do it. So we were always coming up with ideas to make money. And so we had come up with this great idea. We were going to photocopy dollar bills. And so Mom had to come in and teach us that you're not allowed to copy money. You're not allowed to destroy money. You're not allowed to counterfeit money. That's illegal to counterfeit money.
Yeah.
I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 2022 tax facts. And we have this show because people don't know what they don't know. And we want to educate people to be able to know what they don't know, or at least be able to ask the questions so they can find out what they don't know. And so as we talk about that, Daniel, I love your stories. You always do great. I love hearing about stuff that you and your brothers did while you were growing up. I was out working hard myself, and that's where you guys got that work ethic from, right? But, so I don't hear all these stories, and I only hear from what you guys, tend to relinquish here and there. So I love hearing these things. But, but that's exactly what the government is doing, right? They're counterfeiting money, right?
Well, Mom taught us that you're not allowed to counterfeit money. You go to jail if you counterfeit money, right? If you create your own money, if you create your own state money, if you photocopy money, you go to jail. That's illegal. But yeah, the government has a printing press, and right now, So if we want to talk, like, technically, quantitative easing is not printing money, right?
Technically, right.
But for the people who understand that out there, it's not really printing money, okay? We understand that. But for all other purposes, it's increasing the money supply, and it's stealing money from savers, right?
Just as if others counterfeited it. That's why they go after counterfeiters, because it's stealing money from savers, from others. And that's the same thing, but good. Right. Go ahead.
And so she taught us that, but she didn't teach us that the government is allowed to create money. They're allowed to create as much as they want. And you can go read Stephanie Kelton's book. We're not going to give it out because we don't want anybody to think we believe in NMT. But if you want to know about NMT, go read Stephanie Kelton's book on it. And this isn't a joke. You might read it and think it's a joke, but it's actually serious what people are trying to push, where you could create as much money as you want and there won't be any consequences. Yeah, so currently, for every dollar the U.S. is spending, 53 cents of that is being borrowed.
Whoa.
And we just hit $30 trillion of debt. The U.S., $30 trillion of debt. And so we're talking about taxes because these are serious issues that are typically resolved two ways. One, taxes go up. Two, you debase the currency enough so that the debts are inflated away. And so either of those, if you're not positioned properly tax-wise, can cause serious consequences to your portfolio. Because you think about it like this: if your portfolio goes up because they're inflating the debt away, you're happy. Your IRA had $1 million in it, and now it has $2.5 million in it. Well, in order to get all that money out, you have to pay taxes on that.
Right.
Okay. So the tax revenue just went up tremendously because your asset went up, but you don't get to keep all that money. Whereas if you plan ahead and that same situation happened, and now your $2.5 million can come out tax free if it's in a Roth or a similar thing to that, right?
Right.
And so these are things that are a bigger deal when you look at the whole macro picture, when you look at the monetary system, that these are bigger things that you can start protecting yourself now before all the big changes are occurring.
Yeah. And, with what you're talking about, I want to tell people in our listening audience that, our show, they're coming for you. We'll give you more inclination and more ideas in regard to what's going on that. But if you just picked up, listening to us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 2022 tax facts. And we're going through and giving you some ideas for how you can take care of things in 2022 and planning as we go ahead and move forward from that standpoint. But we have a paper that we like to give you that goes along with this called Financial Advice during a Crisis. And you can have that paper for free by calling us at 800-725-7616. Just ask for it by the crisis paper, and we'll be glad to get that to you. Daniel, this is crazy how the government's printing that money, but, I want to get back to the tax aspect. And, we're talking about, we had talked about Roths, and we have more to talk about from that standpoint, right? Because people currently, for Roth conversions, there is no limit as far as how much you can convert from your IRA to your Roth IRA. Now, for those in our listening audience, please don't try this at home. Don't try this without doing the calculations and the proper analysis. I've had people do that in the past where I gave them an idea, they took it, they ran with it, and then they came back and yelled at me because of the taxation that they didn't take into consideration. I said, well, but I thought you were going to have me do it for you, and I was going to take care of all that. But, because there's taxation, there's things, how it can affect your Social Security, how it can affect your Medicare payments, all kinds of different ramifications. But the concept is you can convert as much of your IRA to Roth IRA right now as possible, which is a wonderful thing. There's no income limit on it. In the past, there was an income limit that if you had to be below a certain income to do any Roth conversion, but now there's not. So that's a crazy thing. That is kind of a legal. It's kind of a loophole in a certain sense, but the government is aware of it. And, President Biden was trying to get rid of that last year. And I think right now it's not as much on the table, but I think they have that earmarked when, Daniel, you're talking about how the IRS is trying to find ways of being able to get money for them. And this is one of the things that they're trying to figure out, right?
Well, yeah, you see that there has to be. And so I'm all for paying taxes because I enjoy, I like having a military. I don't agree with everything that they do or how they spend the money, but it's nice feeling safe that we have a military that can keep us safe, that we have freedom here, that we have roads, that we have these things. But when you start adding up all the taxes and you're saying you're paying something like 50% or more, depending where you live, 60% in the different tax. I'm not just talking about income tax.
Right.
60%
exactly.
of the money you were spending 60%. So I go to work and 60% of that time at work is going to the government.
Right.
That's insane. Yep. I don't get that kind of benefit. So when we're talking about these things, I have no problems with paying taxes, but to get that 60% or 50% or whatever that is of all the different things down as low as you can when it's legal, that's what we're talking about, trying to help people to do. And so you're talking about that Roth. To do the conversion, you have to pay taxes on it now. But if you use other things like charitable contributions and some of these other deductions that are allowed right now, or maybe it's maxing out a Roth or an IRA and doing a conversion on a Roth or things like that, there's different things you could do in order to get that taxable income down so that as inflation happens, as asset inflation happens, as taxes rise, you're
Mhm.
already protected, right, from that.
Yeah.
And there's no limit on the dollar amount. So that's why you were saying it may be kind of like a loophole. It's technically not a loophole, but it works like that because you can only contribute so much to a Roth, yet you could convert all that
That's
you want, right? So if you
right.
had $1 million, you could convert
You
all $1
could.
million to
Wouldn't
an
recommend
IRA
it. Right.
or to a Roth IRA. Now, you pay some serious taxes, and maybe you decide that that's worth it to pay
Right.
those taxes so that it can grow tax free. But usually,
Right.
there's strategies that you use to do it over a period of time, or to keep, like you were said, keep you inside those brackets, so you're
Right.
not paying too much. But those are the strategies that you're able to use. But that's important for people to know.
Yes,
There's
definitely.
not a limit on the amount, and you don't have to, you said this already, but you don't have to have earned income to convert. You
Right.
do have to have earned income to make a contribution, but not to convert
Excellent.
on the
Good
Roth
info.
side.
Yes, exactly. And Daniel, this is excellent info. And again, in our listening audience, don't try this at home. Take these concepts, talk to your tax advisor to be able to help you with this and figure all this out. But Daniel, one of the things that I was thinking about is, I have so many with what you just mentioned. I just had an aha moment with what you said, because so many times I'm doing reviews with our clients, and they're saying things like, well, Andrew, what's going to happen with inflation? How is that going to come into play here? And it's really interesting, Daniel, because yesterday I had a review with one of our clients where his income, retirement, he's not yet retired. He's 60 years old. His retirement income went up over 15% from last year. I said, inflation is 7. You went up over 15. How's that sound? You doubled it. That's keeping up with inflation, right? But the aha moment that I just had was the aspect of we're helping people keep up with inflation because we're doing Roth conversions for them. And it's always been I'm thinking of it of a tax savings thing, so they don't have to spend so much money in taxes, because if it's tax free, it's for me, right? And but the other thing it's doing is helping them to stay up with inflation or pass inflation. Phenomenal standpoint. Wow. I could have had a V8. No, that's wonderful, Daniel. That's great. Well, if you just joined us, I get a little passionate about these things. And Daniel does too at certain times. But anyway, financial strategy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 2022 tax facts. And we have a book that we're giving away today before we go to break. And this book is called Tax Invisible, How to Make Your Money Tax Invisible, or invisible to the IRS legally. And it's just a short booklet. It's not very long, not very long at all. It's more of a booklet than a book, but we'd love to give this out to you, get your thoughts on it. And it's for free, no obligation, calling 800-725-7616, 800-725-7616, or you could check us out on our website, agemy.com, agemy.com, the 2 words, Agemy, spell our last name of Agemy. Check it out. We got different information on there, different papers and our podcasts and all those kinds of things that you may be able to get more education, because we do financial strategies because people don't know what people don't know. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
I was having a review with our client, Mary, and when I was doing that, I noticed that Mary had a RMD of $80,000. So Mary, I know that you give a lot of, you give money to your church every year. How would you like to, only pay taxes on $40,000 of that $80,000 RMD? You take $80,000 out, but only pay taxes on 40. Her mouth dropped. How in the world can I do that legally, Andrew? and not put myself in jail. I said, it's a simple thing, the 3 letters QCD. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about tax facts for 2022. And Dad, that sounds too good to be true. How in the world can somebody take out $80,000 and only pay tax on 40?
Well, in this situation, QCD stands for Qualified Charitable Distribution. And when you turn 70 and a half, you don't have to wait till 72, but at 70 and a half, this is available for people to where they can give money directly out of their IRAs to a charitable organization, nonprofit organization. And when they do, they never pay tax on it. So, and it qualifies as part of your RMD. So, this client is giving, $40,000 a year to their church or various organizations, and that money comes out of the IRA and goes directly to them. That $40,000 satisfies $40,000 of the RMD. Now they only have to pay tax on the other $40,000 of their RMD. So they've lowered their taxation significantly on that point. And then the money that they would have paid or given to the organizations out of their pockets is able to be used for other things or to be invested or whatever the case may be. So it's a great opportunity that the government has given people who are charitably minded. But not everybody is that way. But it's a great thing where you can lower your taxable income from that.
So that's another one of the things that's changed in 2022 is that the standard deduction has gone up to $25,900 for married filing jointly. And so if you are used to giving money to your church, right? I think that law changed in 2016 or 2017, but it used to be you could deduct those from your taxes and not pay tax on that. But what's happened is that deduction is so high, right? Almost $26,000.
Right.
And so if you wrote a check for $40,000, you could deduct that, but you'd lose your $25,000 standard deduction.
Right.
And you're saying that if people get these set up from their brokerage account, so from their IRA,
right,
and the custodian, right? So the TD Ameritrade Fidelity, Charles Schwab sends that money to the charity directly.
Right.
That money doesn't even show up on
the
tax return. So you get to give the money to the charity. You get your full standard deduction, and it doesn't show up on the tax return.
Right. Well, it technically shows up on the tax return and it says QCD next to it, meaning that it's not taxable. So in that example, right, she takes $80,000 out of her IRA, and the taxable portion would say $40,000 on the tax, and it would say QCD next to it, meaning that the other 40 went from QCD. But yes, exactly, that's the case. And so you can have your cake and eat it too, because actually, Daniel, for people over 65, the standard deduction now is over $27,000 in 2022. So that's a lot of money. Most people don't give that much money to the church, but they might give $5,000 or whatever, right? Whatever the number is. And if they're giving that through their pocketbook as opposed from their IRA, they're not getting any taxable credit on that. But that's a way that they can have their cake and eat it too. They can still get the credit for it if they're over 70 and a half, and still take the standard deduction. And, that's a beautiful thing, being able to have your cake and eat it too. I always like that.
Yeah. So that's something we've seen brokerage accounts. They don't always count that as a QCD. A lot of times they'll count it as unknown. So we're talking about 2022, but for 2021, if you haven't done your taxes yet, make sure that you tell your tax professional that you did that, because they may ask you, why does this say unknown? Or they may not. And so you want to make sure that they know that you did QCDs if you did. And if you haven't done QCDs, then check that out, because that could save you huge money. And if you don't care about your money, you're like, I got plenty of money. It doesn't matter to me if I get this or not. Well, then do it anyways and bump the amount up so that the charity gets extra money, because they could use it. They could do nice things. There's all kinds of people that need good, right? There's plenty of money just going around destroying capital, right? Giving money to things so find those good charities. If you need some good charities, give us a call and we'll give you a list of good charities.
Exactly. Right.
But give it to a good charity, and it doesn't cost you anything extra, because now you're not paying taxes on it where before you were. So that's something that a lot of people don't understand or know. And AAA, we have told people about this and they kind of poo-poo it, right?
Right.
Then they come back to us later. We've seen this before. And they say, hey, I had a great idea. Did you know about this? And you just kind of smile, right?
Right. I was just thinking of an example in my head where that happened to me last week. It's exactly. And that's the point. And I, that person that said that to me last week, I was like, well, we do this he said, you can do this. I said, yeah, we can do this. We do it all the time. We have people that are charitably minded, a ton of them. And we bring this up to them, which is not what you're typically going to get from your normal, the normal financial person out there, because they're told they can't do taxes. And then you're not going to get it from your tax person, because they're so involved in preparing the taxes. They don't think about what you can do to plan ahead. If you say to them, well, can I do this? They'll say, yeah, sure. But they won't suggest it. They're not typically proactive like that. So that's key. And, so if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. So we want to inform you. Today's topic is 2022 tax facts. And we have a paper that we'd like to put in your hand that explains this QCD, qualified charitable distribution, in a better form. It's called How to Give and Receive Charitable Contributions. And we'd love to put that in your hand by calling 800-725-7616 or checking us out at our website, agemy.com, agemy.com. Let us know that you want the charitable contributions paper. Daniel, when we're talking about these things, one of the things that people, we just talked about the standard deduction. Most people with the tax changes that happened in 2018 are now taking the standard deduction, and as opposed to itemizing. In the past, a lot of people itemize and they don't have to do that anymore. And so that makes things easier, which was one of the reasons for those tax changes. It was supposed to become easier for people, and the tax rates went down from that standpoint. And for those in our listening audience that may not understand, currently the bottom tax rate is 10%. So that means you pay tax on the first portion of if you have $20,000, you're paying 10% on 20, and then above that you're paying 12% on just the piece above that, and then you're paying 22% on the piece above that, and then you're paying 24% on the piece above that, et cetera, and so forth. Many times people will say to me, or I'll say to people, how much did you pay in taxes last year? And they said, oh, I didn't pay anything. I got money back. And I have to chuckle inside, because most people pay some kind of taxes. You might get money back, because what's happening is your paycheck or whatever, there's withholding going on, and maybe you had $10,000 withheld, but you get $3,000 back. Well, in that example, you paid $7,000 of taxes. You still got money back, but you paid, 7 of the 10 went for paying taxes. So, this is something I want to bring to people's attention so that they can have some kind of idea what's going on with that. But this is an important thing to know. This qualified charitable distribution is important. I think you probably have some things to go along with this, Daniel, from that standpoint.
Well, it was a big deal to have an income tax back when tax started, but it was for a war. And so people got behind that and they believed in that purpose, and it was supposed to be temporary, right? And
World
then
War One, right?
taxes started going up,
Okay.
and then taxes started going up. And then somebody had a great
And they
idea
start going up.
that instead of people having to write a check at when they do their taxes, we'll
Yeah.
just start deducting it out of their paycheck.
Right.
So I don't think taxes would ever be as high as they are today if that never happened, because
Right.
people would be irate if they actually had to write a check for that number at the end of the year. But now, because it just comes out little by little, people are just, well, it's what we do, right?
Right.
And it's caused bad behavior, shall we say, in Washington, where instead of balancing the budget, it's just we'll increase the debt ceiling, or we'll increase the taxes, or those kinds of things. And so so when we're able to use some of these things to reduce that taxes, at least people know that they're still benefiting, right? They're still paying for all the good things we get, but maybe they'll help Congress, they'll help the government be a little bit more responsible, because they see people know what they're doing, instead of, well, it comes out of my check, I'm getting money back, I didn't actually pay anything, like you were talking about earlier.
Right, exactly. And what about, the cap, when we're talking about this stuff, there's also, the capital gains rate that comes into play, and what, where we stand with that, which, do you want to go into that at this point? Well, tell us a little bit about qualified dividends and how they're taxed, maybe. What do you think?
Well, I think we need to take a break here.
Okay, well, you're listening to Financial Strategies with Andrew and Daniel Agemy, and today's topic is 2022 tax facts, and we have a book for you that we'd like to give you that's called Tax Invisible, and how to legally hide your taxes, how to hide your growth, hide your money from the IRS, to be able to not have to pay taxes on that. And so we'd like to put this in your hands. Very easy to read book, very short. 800-725-7616. Love to be able to give this to you, and you can have it by calling us now, 800-725-7616. Ask for the book, Tax Invisible. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
I was talking to my brother the other day, and he trains people to make good decisions, and decisions that their lives depend on the decisions. And we were talking about third and fourth order consequences for decisions people make. And in the investment world, there's, you can make a decision. I'm going to buy this stock, or I'm going to buy this basket of stocks, and it'll go up or down. And that's first order consequences. It goes up or down. But there's other things where it affects you in different ways, or the purchase of that may cause a cause and effect, where you had an opportunity cost by not buying this other thing over here. And it can escalate down into second order consequences and third order consequences and fourth order consequences. And we always are trying to do the absolute best we can to protect on a risk management side of third and fourth order consequences. But this involves taxes as well. I'm Daniel Agemy.
And I'm Andrew Agemy. And you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We're here to talk to you about that. Today's topic is 2022 tax facts. And Daniel, that's, talking about the third and fourth order, that's very key. When it comes to the investment side, like you're saying, there's all these different consequences. One of those things that people are familiar with when it comes to that is, a growth, like you said, it could go up or it could go down. Well, if it goes up and then you sell it, well, now a consequence of that is now you got capital gains tax that you're paying on the gain on that thing. And, that's when we're talking
Or
about tax.
another one is now you have to do something with the money. And do you
Right.
have a better investment than that one that you just sold? Is there a better opportunity? So there's a lot going in order there.
Exactly. And that takes a lot of due diligence on your part when you're managing the money for our clients to make sure that all those things are taken care of. And I appreciate that. Thank you. And in the same way, when I'm looking at people's portfolios and seeing how to diversify tax strategies or whatever the case may be, the same thing. And that's why I said earlier to people, don't try this Roth conversion at home. And the reason I said that is because second, third, and fourth order consequences that come into play from that. Well, let's just piggyback. Let's go back for a moment to the capital gain issue, right? So people are sometimes unclear on how the capital gains work. And if you have $80,000 of income, over $80,000 of income, and 20,000, then have a $20,000 capital gain, you're going to pay 15% tax on that $20,000 gain. And the gain is the amount of money that you earn. So if you invested $100,000 and sold it for $120,000, you're going to pay, your gain is the $20,000 that you're going to pay 15% on. But if that $20,000 and the rest of your income was below $80,000, you're not going to pay any gain on that. So there's sometimes a disconnect when people are thinking about that, because they think, well, I make $80,000 and I make $20,000 capital gain, so I'm not going to pay any capital gain tax on that. That's not true. It's actually going to take you up to pay that capital gains tax. But one of the things along with that, though, when we're managing money, is qualified dividends, because they're taxed differently from ordinary income, right, Daniel?
Right. So a qualified dividend is taxed at short or long-term capital gains. And so basically what that means is, this is another thing that changed in 2022. The number went up. So now, if you were married filing jointly and you have less than 80,800 of income, your qualified dividends are zero tax. So this is where, when you're putting together that diversified portfolio, you have to see which buckets of money make sense in which thing. Because if you're going to be collecting tax-free money,
right,
from a non-qualified account, well, that's pretty awesome, right? You let's say you've got $500,000 in a non-qualified account, and that's paying you $25,000 in dividends.
Yeah.
And the majority of that is qualified dividends. You could potentially be not paying any taxes on that.
Sweet. That's a nice place to be. I like that. If it's tax-free, it's for me. I like those things. Well, if you've just picked up listening to us or whatnot, I want to remind you to listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 2022 tax facts. And we're glad to have you with us. We're giving away a report today that you can have for free. It's called How to Give and Receive Charitable Contributions. And it's talking about the QCD that we mentioned earlier, Qualified Charitable Distribution. And we would like to put that in your hand by calling us at 800-725-7616. If you're charitable minded at all, this is an important thing that'd be able to save you money on taxes. 800-725-7616. Daniel, this qualified dividend is an important thing to be able to get information, get tax free for some people, or at least lower rates for others. But then with that, when we're talking about second or third generation, fourth generation consequences, comes into play when people are making this money, they're making dividends or they're making capital gains. It can affect other things, like it can affect the taxes that you pay on your Social Security. Some people don't pay any taxes on Social Security because their incomes are low. So other people pay tax on 85% of their Social Security because their incomes are high. And some people are in between. And those in between people can get stuck in maybe paying double taxes on their, if they take out $5,000, they're paying tax on 10 because $5,000 more of their Social Security was taxed because of that. So that's one of those second, third, fourth generation items. And then, another one is what's called IRMA, which stands for Income Related Monthly Adjusted Amount. That is can affect what you pay in your Medicare Part B premiums. So even though it's considered an increase in premium, it's still a kind of a tax that if you make over a certain amount of money, whether you're single or married, you will pay more. Like the basic rate is somewhere around $140, $150 a month for Part B. And if you have IRMA come into play, that might be $200 a month, or depending how much IRMA and how much income you have, it might go as high as $400 to $500 a month for one person's Medicare Part B premium because of this. So again, these second, these third, these fourth generation consequences are something that need to be looked at and addressed for, making sure that you don't pay more than what is your fair share of taxes. You agree?
Well, you just gave out that white paper, and that's a perfect example of watching the second order consequences, right? Where it's good to plan ahead, especially on these Roth conversions, because things happen, right? So when you're going to work, there's not as many. Your income's pretty consistent. You know how much you're making. You're not taking random taxable distributions. Your income is your income.
Right.
If you're not taking Social Security, that's not affected either. So it's much easier for you to start conversions ahead of time because you can manage your tax burdens. Whereas if you are collecting Social Security, you have this IRMA stuff going on, you have these different things, and then you need some money, and you take it out of your IRA, boom. Or you have to take an RMD, right? And you don't do a charitable contribution, boom, $40,000. Now your Social Security just be taxed. Your dividends went from maybe 0 to 15, right?
Yeah.
So and you get smacked all these different places, and so that's why it's not. The tax code is not so simple. Now, having that nice big standard deduction helps out with a lot of stuff, because if you're not earning a lot of money, $26,000, $27,000 right off the bat is a great thing to help you with those. But to protect yourself and give yourself some leeway like that, like we said, if you start converting Roths earlier, and then you have an unexpected event, you could take money out of your Roth and you don't get your Social Security, and it become taxable.
Exactly.
You take your RMD out and you use this way. Now you've got more wiggle room in case you had an unexpected, or you want to go to Hawaii and you got to take money out of your IRA, right? These kinds of things. And so watching those, definitely second order consequences, but looking at those third and fourth too, these are tools that you can talk to your tax advisor about to help you get positioned ahead of time. And if you're earlier in this stage, right, and you want to start doing conversions, get together a tax conversion plan, right? A Roth conversion plan, so you can get more of that money and have more flexibility in the future. So you don't make one of these decisions. I need some money. And now all of a sudden, 3 things that you weren't paying tax on just became taxable.
Exactly. That's great advice, Daniel. I love that. And, that's where many times, we've worked with people in their 50s and even 60s to prepare for age 72 years old and RMDs and or even 65, because once you start on Social Security and getting Medicare, well, now we've got some real third and fourth generation consequences, whereas the earlier we do it can work real well for people. So these are things, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 2022 tax facts, because people don't know what people don't know. And many times, if you have a financial person, they don't know these things that we're telling you today because they're not versed in taxes. And they're told by their firms that they can't give tax advice. You go to your tax person and maybe they know these things, but they're typically not going to tell you these things or be proactive in that, because they're so much depending upon preparing your taxes and crunching the numbers. Get some information and help and ask the right questions so that you can be prepared for the future. You can't predict, but you can prepare. Well, we're giving away this book today called Tax Invisible. We'd love to put this in your hands. Please call us at 800-725-7616 if you want your free copy of this, and we'll get that out to you. 800-725-7616. And with that, I'm glad that you were able to join us today, and you too can have a stress-free income.